The next section of the classified balance sheet is liabilities. And that starts with your current liabilities. Current liabilities are those obligations that are expected to be paid within 1 year or the operating cycle, whichever is longer. Some examples of those are notes payables, accounts payables, wages payables, bank loans payables, interest payables, taxes payables, and the current maturity of long-term obligations. Those are the payments, the principal payments that are to be made within the next year on long-term obligations. Within the current liabilities section, companies usually list them in the order starting with notes payable first, and then accounts payable, and then the remaining items are listed in the order of their magnitude. So I'm going to take just a second and talk to you a little bit about some of the different types of payables. We go into these more in depth in later classes, in later courses, but just to kind of give you a working familiarity. So wages payable are the amount of salaries and wages that are due to your employees, but you have yet to cut the paycheck. So for example, the pay period ends on Friday. All the hours up to that Friday, you will need to pay your employees. On that Friday, you have salaries and wages payable from that Friday until the day that you actually cut the check. So if checks are distributed on the following Wednesday, during Monday, Tuesday, and part of Wednesday until you actually distribute and cut the checks, those are payable. They haven't been paid yet. Notes payable is, again, as we discussed with notes receivable, that can be either current or long-term, depending on the terms of the note. A notes payable is more formal, will have interest attached to it, payment terms, an actual contract. Interest payable is the amount of interest you owe on something. So, for example, if you have a bond issue, you are accruing interest. If you have interest due on a note, that's what an interest payable is. An income taxes payable is the accruing of the amount of taxes that you will need to remit to a taxing jurisdiction, depending upon what city you're in, what state, and of course there's federal income taxes payable. Let's take a moment to look at the current liability section of Google's balance sheet. So this is just part of a balance sheet. And you'll notice that they don't have any notes payable because otherwise it would start with notes payable. But they have accounts payable, and then they run into the other types of current liabilities they have. They have some short-term debt, accrued compensation and benefits, accrued expenses and other current liabilities, and then income taxes payable nets. Notice from short-term debt all the way down to income taxes payable net, those amounts, with the exception of accrued expenses and other current liabilities, are in the order of magnitude. That is how much they are. The accrued expenses and other current liabilities is a master reporting. So there's a lot of other smaller amounts that are comprised in that. So that's why that number is so big, but not near the top, because it's really a bunch of little numbers that don't have a significant materiality on each of their own merits. After the current liabilities section, we then have our long-term liabilities section. So long-term liabilities are those obligations that a company expects to pay after 1 year. Liabilities that fall in this category can include bonds payable, mortgages payable, long-term notes payable, lease liabilities, pension liabilities. Many companies report their long-term debt maturing after 1 year as a single amount in the balance sheet. And then what they do is they show the details of the debt in notes that accompany the financial statements. So if we look here, we see bonds payable. That 1,106 could actually be comprised of half a dozen different bonds. There would be an additional schedule that would show that detail in the financial statements. Now, we've kind of talked and mentioned the word bonds quite a few times already. The difference between a bonds payable and a notes payable is that a notes payable is between the company and one other entity. It is a formalized loan, whereas a bond is a financial instrument that the company markets to the general public. That's the biggest way to look at it. There is one payee, typically with notes payable, whereas with bonds payable, you can have thousands of payees. With bonds payable and notes payable, there's a lot of things that are similar about them, and you'll learn about that in later classes. But the easiest way to think of it is the bonds payable is that financial instrument that is exchanged on the stock exchanges. The notes payable is a one-to-one contract and loan. So which of these following is not a long-term liability? I want you to take a second and look at it. You should come up with the current maturity of long-term debt is not a long-term liability. That is the portion of principal that is expected to be paid in the next year or the operating cycle. We're going to introduce you just a little bit more to the concept of stockholders' equity today. So, stockholders' equity can be very, very complicated. What we do is we start you off with the most common and the basic elements of stockholders' equity, and then we'll build on it in later classes. So later courses, we really dig into stockholders' equity more. What you need to know is that stockholders' equity, the actual stock, is identified in accounts such as common stock being the name. This is the investments of assets into the business by the stockholders. So that could be they invested by contributing a vehicle or they purchased an actual stock. And then retained earnings, which you will see on most classified balance sheets, indicates the amount of income that has been retained for use in the business. Companies can issue different types of stock, and sometimes common stock is called capital stock. I believe it is ACC 122 where we really dig into the stockholders' equity section of the balance sheet and talk about it more. Until then, you're going to have common stock. There should only be one type of stock, although in reality, many organizations have half a dozen or more types of stock. We will end this particular lecture here as we have completed assets and then liabilities and stockholders' equity. Just a refreshing reminder, the accounting equation is assets equals liabilities plus stockholders' equity. Next, we'll go into talking about using things like ratios and how we use the information in the classified balance sheet and the other financial statements to tell us things about an organization's performance, its profitability, its liquidity, its solvency,